Welcome to FinScale, a podcast created by Solène Niederkorn, shedding light on innovation in finance, banking, and insurance.
Investing for Change, a deep dive into carbon equity's journey. Jacqueline van den Ende, CEO and co-founder of Carbon Equity.
A lot of climate tech is deep tech. US has definitely the best ecosystem for deep tech because they have much larger funds and there's a greater risk appetite and you have a bigger market to serve. Followed by Europe. And the reason why Europe has always been a leader in this space is that we have rather forward regulation. So Europe has the European Green Deal. The US obviously just introduced the Inflation Reduction Act, which is a huge push for climate technology. But Europe has always been leading when it comes to green policies and a push from the regulator. And now what we see is that Asia is really starting to emerge. So especially China, of course, is no longer the follower, but really starting to become a leader and starting to really dominate certain industries.
Get ready to be swept off your feet by the exciting journey of a passionate entrepreneur, Jacqueline. She's there to demystify the world of alternative climate funds, whether it's infrastructure, real estate, private equity, growth, or venture capital. Her motto, it is time to finance companies that are changing the world. We'll also explore the incredible potential of this platform, which is making alternative assets more accessible. Jacqueline will share all the nitty-gritty details that went into setting up Carbon Equity, from fund type and ticket size to marketing and distribution and secondary market setup. Recently, Carbon Equity created a new vehicle that is open to investors who want to change the world by financing the economy of the future. Tune in for an informative and exciting episode. Enjoy the show! Hi, everyone. Hi, Jacqueline.
Hi, very nice to be here.
Yeah, super excited to have that recording with you. I was expecting that recording already 6 or 8 months ago. You've been working in private equity for quite a while, and then you have been inspired by, you will tell us what happened and why you launched Carbon Equity. Can you please start by introducing yourself to the audience?
Yeah, sure. So pleasure to be here. My name is Jacqueline. I'm one of the co-founders and the CEO of Carbon Equity. And indeed, I have a mixed career. I spent more or less half of my career as an investor, initially in private equity, later as a partner in a VC fund. Mm-hmm. And the other half I spent building companies, amongst which almost 6 years in Southeast Asia, working with Rocket Internet and Ant Financial, building fintech company and an online real estate company. So I like to build and invest in companies.
Perfect. So there is a lot to say about Carbon Equity. But prior to that, I wanted that you explain to us the typology of climate funds, because I recently published an episode with Isabelle Albert that you know from Sat Ghana. So
yes.
we deep dived into a VC climate fund, but there are many other climate funds, and I think that maybe not everyone knows that you might have infrastructure climate funds, you might have real estate funds, so would be worth stopping a few minutes and that you explain to us what are those climate funds, what they represent, and how did it evolve over the last, let's say, 5 years.
Yeah, great question, because you're absolutely right that climate investing is often automatically associated with very early stage, deep tech, venture type investments. But you could say that there are climate funds across all asset classes. So if we look at the private equity space, you have venture capital climate funds, growth equity climate funds who are investing in scale-ups, Series C and beyond, and you have buyout funds. We recently invested in Ara Partners, which is a really cool climate buyout fund. Mm-hmm. And then you also have, as you mentioned, real estate funds, which only invest in zero carbon real estate. And you've got infrastructure funds. And also these infrastructure funds play a huge role in the energy transition, because they are financing things such as windmills and solar panel infrastructure, but also grid improvements, or, for example, manufacturing facilities for green steel, green cement, etc. So climate spans everything.
And you didn't talk about crypto.
No,
You have
good
green blockchains.
That is correct. And there are also a whole bunch of climate crypto fintech companies that are trying to solve, for example, the carbon offset problem using blockchain technology. So definitely a lot happening there as well.
Excellent. Perfect. So amongst all those different verticals and typology of asset classes, which is the one that is the most important in terms of assets? Do you have an idea?
For me, I would say intuitively venture growth and infrastructure.
Okay.
And the reason why I say that, venture has a huge role to play in driving innovation. So part of the technologies that we need to evolve towards a zero carbon future are already known, but part of them are still very nascent or have not even been invented yet. Think about nuclear fusion. That could be a totally game-changing technology, but it's very early stage. Then growth equity plays a very big role in scaling up those technologies and making sure that, think about plant-based meat, think about vertical farming, think about technologies that are beyond technology risk and now need to drive as much adoption as possible. And then if you look at the total financing need to finance energy transition, I think it's approximately 7 trillion a year. The vast majority of that is infrastructure investment. So therefore those three: innovation and transition.
Okay. And amongst the different geographies, who would you say are the first movers? Who were the first movers? The United States, Asian, African funds? Which ones did we already see years ago launching and raising funds?
I'm going to say the US has always, so a lot of climate tech is deep tech. US has definitely the best ecosystem for deep tech because they have much larger funds and there's a greater risk appetite and you have a bigger market to serve. Followed by Europe. And the reason why Europe has always been a leader in this space is that we have rather forward regulation. So Europe has the European Green Deal. The US obviously just introduced the Inflation Reduction Act, which is a huge push for climate technology. But Europe has always been leading when it comes to green policies and a push from the regulator. And now what we see is that Asia is really starting to emerge. So especially China, of course, is no longer the follower, but really starting to become a leader and starting to really dominate certain industries. Think about electric vehicles. They're really coming for Europe and the US. Initially we had Tesla, but it's going to be way more Chinese competitors in the market. But even also markets such as India are really starting to step up their climate game.
And in terms of performances, what kind of performances can we expect from those funds?
Yeah, performance is always hard to predict. I can share some historical numbers. So, for example, if you look at the period 2015 to 2019, bearing in mind that that was part of the bull run, right? So the bull run of the market started in, I would say, after the last financial crisis, 2014, and then things went up and up and up and up. But if you look at the period 2015 to 2019, early stage climate tech returned 29% IRR versus 14% for global private equity and VC.
Okay.
So
right.
This is actually one of the first times that climate tech outperformed the general market. But of course, this is no guarantee for the future.
Okay. So at Carbon Equity, you're a fund of funds. What are the do's and don'ts? So maybe we will explain this afterwards. You will explain to us the selection process. But generally speaking, what are the do's and don'ts when you select a fund and fields in which you absolutely wouldn't like to go, either from for performance reasons or for timing or for sectors?
Yeah.
And the one you favor the most.
So a couple of things here. I think overall climate tech is two things. One, it's a very broad landscape. So it spans agro-food, mobility, energy, built environments, carbon capture and storage, the whole supply chain, industry. So it's very broad, and climate tech touches almost every industry. So that's often a mistake. People misinterpret climate tech as only energy related, but in reality, it is a much broader topic. The second thing about climate technology, at least in the venture space, is that it's relatively young. When we look at funds, they're maybe in their second, their third vintage, but we don't have, compared to the general private equity space, there is no Fund 10 similar to Carlyle or KKR Fund 10 or Fund 15, for example. So what is important in that space is, for us, a couple of things. One is selection of funds that are truly best in class in climate impact. And we're going to talk a little bit more about that, about how we determine that. But there are a lot of funds that are, well, not necessarily greenwashing, but they want to ride the wave of climate tech being hot. And so they rebrand into being a climate tech fund without necessarily having the substance and the rigor of truly being a climate impact investor.
It's a makeup exercise.
Yes, exactly. A little bit. The other thing is diversification. And that is why a fund of funds structure in this case makes a whole lot of sense, because the more diversification, the less risky it is to invest in this domain, because it is relatively more risky than, let's say, SaaS model investing. So climate tech is characterized by more hardware, more capital intensive, more deep tech earlier. And often it can be that you have both unproven tech and unproven business models. If you compare that to software as a service, as an investment domain, that's a much more proven model, much less exciting, less impact. But therefore, if you invest in climate tech, it makes sense to diversify.
Okay, excellent. So if we go back to the starting point when you decided to co-found with your founders Carbon Equity, can you put us in your shoes and explain to us how it happened and what was the trigger and why you decided to build that new value proposition?
Yes. Yeah, great question. I have always been quite concerned about climate change. I would say since 2004, The Inconvenient Truth by Al Gore, but it was a little bit of back of mind awareness. And then in 2019, I read the book, The Sixth Extinction, and it talks about the 5 major extinctions in the history of the planet, also, and the extinction of the dinosaurs. And she shows us that how since the Industrial Revolution, just 200-300 years ago, temperature increases, loss of biodiversity have really gone at such a high, fast pace that is unprecedented in history. And it really drove home the message to me that we live in a possibly the most critical time in humanity has ever experienced. We're literally on the verge of destroying the planet, which could ultimately lead to human extinction. So for me, that was personally really a wake-up call of like, whoa, how can I spend my, it doesn't make any sense to spend my time not solving climate change, if you understand what I mean. Like, this is the biggest problem to solve at this point, and I want to dedicate my career to that. So that was step one on why I embarked on this journey. The second was like, how do we have an impact? And I come from a private equity, a venture capital, and a fintech career. And so what I learned in those careers is that ultimately money decides. Money decides what happens in the world.
Yes.
And so basically I said, okay, I want to fight climate change, and I'm going to choose as my weapon is finance. So I start off with the question, how can we really move the needle on climate change with finance? And then what we observed was that trillions of dollars, literally trillions of dollars every year, were moving into ESG stocks, which are listed on the stock exchange. People buying shares of Tesla or these type of companies. That is great, but the impact of buying a share of Tesla on the real economy is virtually nothing. If you buy a share of Tesla, there's not going to be a single car extra on the road.
Yeah.
So our observation was if you want to invest with impact, meaning you change from situation A to situation B, you have much more impact investing in venture capital and private equity, where you directly, with your money, euro for euro, power innovation and growth of these innovations.
Yes, that's true.
And then
Yeah. And this is something that I've been discussing with Bill Kelly from Kaya Association, telling us that the vast majority of companies are not listed. So if you want to move something, you have to go to private equity, which represent a very minor part of assets invested within portfolios worldwide. So this is why I'm very optimistic for the future of carbon equity, because you've pointed out exactly the main point and how you can be a game changer in the economy.
Exactly. You're absolutely right. The statistic is 97% of companies are not listed. So every climate innovation is in the private markets. And then our final observation was, if you look at the amount of money in the world, only a very small fraction of that wealth has access to private equity. And the reason is because typically you need to invest at least 5 million euros to enter a top fund. And then you also need a lot of knowledge to be able to select funds and to get into the fund. You need a strong network for that. So what Carbon Equity seeks to do is to unlock what we call mass affluent net worth. And mass affluent is defined as people with a net worth between 100,000 euros and 10 million. There's 173 trillion in capital with that target market that is 3 times larger than the total institutional asset management market. That's a huge pool of unlocked capital. And to unlock this capital to power breakthrough climate innovations.
Wow. So you realize this, and then how do you proceed? I mean, concretely, you find co-founders, you go to an incubator, you launch your investment firm.
Yeah, this is I think the question on every aspiring entrepreneur's mind, like, how do I get started? Well, one thing I learned, I built several companies before. And the one thing I learned from this is when I have an idea, and I think I have a business idea on average once a month, I tell the whole world about it. So, and what happens when I tell, so a lot of, especially young entrepreneurs are often very afraid that people will steal their ideas and then run off with it. This is not how reality works. What happens in reality is when you share your idea, some people will say, hey, that's a very interesting idea. How can I be part of it? And this is exactly what happened. So I started, sharing this idea. And before I knew it, I had like a team of 4 people. We were initially 5 co-founders. Now we're 4. Of people said, this is really cool. How can I be part of it? And then I'm very open in letting people in. So building a team is really step 1.
So you build the team?
Yes. and then
you raise funds?
Yes. And then you kind of need to just start. And we started by saying, okay, let's try to raise a fund, and let's see what happens. And so Carbon Equity, and you should see us as a curated marketplace. So it's similar to a Moonfair, for example, which offers access to general private equity. You can invest in single funds or in a portfolio fund, which is like multiple funds. And so we started off with a small, tiny single fund, 3.5 million euros. And so we made sure that we got access to this first fund, leveraging our network. And then we created a pitch deck and we started calling our entire network and just trying to get people enthusiastic about investing in this fund. That was much more successful than we expected. I think we sold out that fund in 2.5 weeks. It was really, there was much more interest than we had anticipated. So then we got confidence and said, hey, there's something here. We started to understand that what we do makes sense, because for anybody who has a little bit of capital, it makes sense to invest in climate technology because it's one of the biggest growth themes for the coming decades. It's going to be multiple times multi-billion-dollar markets. And secondly, if you're going to invest in climate technology, you want to do so with the very best funds the world has to offer, and you want to diversify your investments. So what we do makes a lot of sense. And then from that realization, we started scaling what we do.
Wow. So you already have invested in 7 funds?
Yes, correct.
Yeah. Can you please describe the typology of funds? So if we go back like at the beginning of our discussion, you have agri-tech, energy.
Yes.
Yeah. What else?
Yeah, exactly. So we have sort of, at the moment, we've invested in 4 types of funds. We invested 90 million euros to date. We've got an agro-food fund, which is Astanor. They're really cool. They invest in things like vertical farming, plant-based sushi, but also biological fertilizers, really cool innovations. We've got a couple of funds that really focus on energy. Think about Energy Impact Partners Frontier Fund. They're one of my favorites. They invested in a nuclear fusion company, but also in long duration battery storage and in a company that electrifies steel production. So they're really on the energy side. And then we have growth funds. So we have Lightrock, which is a spin-off from LGT, which is one of the largest asset managers in the world. And we have ARA Partners, which is our first growth/buyout fund. And we also invested in an urban technology fund called 2150. They're super cool. And they invest in things like carbon-free cements or using special woods to replace cement with wood structures. So really cool funds.
How can you get access to these funds? Because those are small funds.
I would say the average fund size is for us 300 to 500 million.
Okay.
We do occasionally invest in first-time funds, but we prefer to invest in more experienced fund managers from a risk perspective. So most of the funds would be a fund 2 or a fund 3. But sometimes there is a first-time fund. So 2150 was a first-time fund, but there were some mitigating factors in the sense that very experienced investors who had been investing for decades before they joined 2150 as a partner. They had a partnership with one of the largest real estate developers in the Nordics. So they had a really strong key cornerstone investor, and they had many institutional investors. So we look at these mitigating factors.
And how do you ensure? Sorry, I interrupted you.
No, you were asking me, how do we get in?
Sorry.
Yes. Yes. So we get in. So first of all, we have a very experienced team. 2 of our senior investment team members came from Alpinvest, which is one of the largest institutional investors in the world. And they have a tremendous network with funds. Our head of impact comes from McKinsey, and she has a very strong network in energy transition. And we have a very big network of angel investors and advisors. So Carbon Equity itself is a venture-backed company who also have a very strong network. And so these people have really knocked on all the doors of the funds to make sure that we got an intro with even funds such as Al Gore's fund. So far we've been very successful in making sure that we get access. And a lot of these funds like what we do. So they really support our mission, but also see that there's a lot of sense in getting smaller investors on board, also to share ownership of the net zero economy in a broader way.
And how do you ensure that, because you perform a due diligence process, which is a pure financial one, but from extra financial objectives, to ensure that those funds are not doing greenwashing, how do you process concretely?
Yeah, very good question. So we have 2 processes, and the first process is our climate diligence process. And we're globally one of the most specialized players in really conducting climate diligence. And in the climate diligence, what you want to understand is how is climate impact insured in this fund? So we have developed a huge scorecard and a scoring system which rates funds on a scale of 1 to 5 on 40 different dimensions. And in those dimensions, we'll probably be looking at, for example, what targets is the fund setting at the company level and at the portfolio level? Are they putting their money where their mouth is? Are incentives related to achieving that impact, yes or no? Who is responsible for impact within the team, but also at the investment committee decision-making level? How are they reporting on impact, and what decisions are they making in their actual portfolio? So for us, it's not good enough to see a beautiful impact framework. But then if we look at the portfolio companies or at their pipeline companies and we say, what is the impact rationale? And is this strong enough or is it opportunistic, right? Then those funds will get a high score in the impact scorecard. Funds need to achieve at least a 3.0 out of 5. And I would say that 70% of funds don't make that threshold. So we really try to invest in the very truly best-in-class climate impact funds, that are fully aligned in their team, their processes, their governance, and their execution to realize climate impact.
So only Article 9 funds?
Only, in Europe, Article 9 funds. In the US, you don't have SFDR.
Yes.
So we don't have that classification for the US funds, but we will look at them with the same lens as SFDR 9 funds.
And do you classify yourself as an Article 9?
Yeah, so we have been very conservative in classifying ourselves as an Article 9 because not all underlying funds are Article 9 because US funds are not Article 9. So
good answer.
Classified. Yeah, exactly. And this is obviously an important discussion. The whole SFDR thing is a good thing, right? Because it's very important that we start to understand what is what in the impact landscape. But there's also a lot of SFDR inflation of funds unright and incorrectly labeling themselves as Article 9. And I think it's just better to be correct and have substance rather than making all kinds of claims that you cannot 100% substantiate. So if we cannot 100% have Article 9 funds, we will be careful to classify ourselves as Article 9.
Yeah. And why did you give the possibility to invest directly in funds or via that fund of fund structure?
Yeah, that's a good question. It appeals to different types of customers. So for most customers, the fund of funds is the most logical option because you simply get more diversification. You're invested in 200 companies. So you have a much broader exposure. But for some investors who are very experienced private equity investors, they may already have some exposure to climate tech. And they're looking for a very specific accent in their portfolio. So some people specifically want to invest in growth or buyout type funds. Some people very specifically want to invest in regenerative agriculture. So by offering funds both as single funds or a portfolio of funds, so we basically say you can invest according to your interest. If you're super interested in the built environment or in agro-food, invest in that specific fund. Or you can invest in the whole sector, in which case you want to be investing in our portfolio fund.
Okay. And the minimum size ticket is 100,000 euros.
Yeah, so that is, yes, for most funds, the minimum ticket size has been 100,000 euros. From May onwards, it's going to be 50,000 euros. And last year, we did an experiment, which is called the Climate Investment Club. And there we opened up access from 10,000 euros.
Wow.
The Climate Investment Club is now sold out. So we only had 150 positions open and it's closed at the moment. But we might launch another Climate Investment Club in the future. So when people are interested in signing up for less than 100,000 euros, you can sign up for the wait list and we'll get you a signal as soon as we have a smaller ticket offering.
And how do you manage to give access to those small tickets? Because private equity should only be offered to professional investors in many cases.
Yes, correct. Yes. And so there are... So actually, if you look also at the players who are doing democratizing private equity, a lot of people claim you can invest with us from very low minima, let's say from 10,000 euros, but you still need to be a qualified investor, which means that you need to have 2 million euros in your bank account or have an income of 200,000 euros and above. So carbon equity is actually able to cater towards non-professional investors as well. And the reason for that is that we have a special license in the Netherlands that allows us to offer private equity to non-qualified investors. But that means we're a fully regulated organization. Abroad, in other countries, so not in the Netherlands, we will initially start with marketing towards qualified investors, but also with lower minima. And then country by country, we want to make it possible for people, for non-professional investors to also invest in private equity, but we need to go country by country to obtain the specific licenses. Or perhaps we will make use of an LTIF, the LTIF regulation, which is European Long-Term Investment Fund regulation.
Yeah,
exactly. And that is a regulation that could help, financial institutions like
to passport your
exactly.
fund. Yeah.
Yes, correct. Yeah.
Interesting. It's interesting because I had in my French audio on my French channel one company called Altaroc, which democratized private equity using, giving access to top tier one private equity funds and for a minimum of 100,000 euros. And what was interesting is that he explained, Frédéric Stollard, the CEO of Altaroc, explained to us the go-to-market strategy. It's interesting if you could share also with us the way you proceed, because you were talking about those investors as individuals, but I believe that you also use intermediaries like private banks or family office. What kind of relationship do you build with them?
Yeah, you can say, so Carbon Equity has two divisions. We have retail solutions and we have professional solutions. So on the professional solutions, we work with single multifamily offices who themselves are interested in investing. Mm-hmm. We work with a lot of independent financial advisors, and we work with larger asset managers who are interested in distributing our products to their customers.
Okay.
So there we have sort of a B to B to C type distribution approach.
Okay.
And then in the retail section, we work with individuals who will invest anywhere between 100,000 euros up to a few million. Mm-hmm. And those we deal with directly, and we reach them through inbound and outbound sales channels.
Okay. And how many clients do you have?
At the moment, 400 with 90 million assets under management.
Okay, so I hope after the podcast you'll add other clients. And it's still open. Do you have it's still open or it's blocked for the moment?
We are launching the next, our second vintage of the Climate Tech portfolio of funds, or our Climate Tech fund of funds, tomorrow.
Wow.
So it is, so as of tomorrow, it will be open again. Yes.
So it will be open when I will release the episode.
Exactly.
Excellent.
Yes.
Perfect.
Yeah.
Yeah. One last question about, it's always interesting because private equity, there is always a problem of secondary market and liquidity. Do you intend to provide liquidity to your early investors if they want to sell their positions?
Yes, in due time, yes. So we are planning to have a secondary marketplace. And in the secondary marketplace, it will be possible, there will be trading windows. So let's say 4 times a year, investors in the funds have the option of saying, hey, I want to sell. And people from both inside the platform as outside the platform have the option to buy these secondary investments, which can be very attractive for investors to diversify and also improve the cash flow profile. Mm-hmm. Typically in venture capital investing, it's a lot of cash out for a long time, and it takes a while for cash flows to return. By buying secondaries, you can front load cash flows out of these investments funds. So yes, we will do so. But it is not our top priority. Typically, when we talk with our investors, we clearly state this is in principle, this is an illiquid or a semi-liquid investment, that you should have a time perspective of at least 5 years to hold it. Mm-hmm. Even when you have a secondary market, it is suboptimal to sell within 5 years. So truly only invest with capital that you can afford to set aside for the long term.
Yeah, clearly. I mean, we have to close the discussion. Unfortunately, that was very interesting. A lot of information that you kindly provided. Can you please recommend to us a book or a podcast? That's always what I ask to conclude.
Yes, absolutely. Well, I can highly recommend, if you want to read up on the climate crisis in a really interesting, fascinating way, read the book The Sixth Extinction by Elizabeth Kolbert. It's just really fascinating how history is repeating itself, in this case by humans, and super interesting. She also philosophizes a little bit about what will happen after humans are extinct. And her hypothesis is that rats will take over. Very interesting. And the second book is How to Avoid a Climate Crisis by Bill Gates. For me, that was a very practical handbook, very optimistic as well, where he sketches a really clear set of climate tech solutions to our greenhouse gas problem. So for me, that was very encouraging to also think, okay, there are solutions. What we need is capital and entrepreneurs to make it happen. So
It remains optimistic. That's important.
Yes, I'm optimistic.
Okay, thank you very much, Jacqueline, and thank you, Pauline, for making the introduction. See you soon.
Yes,
bye.
Pleasure.
Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.